What's up, everyone? It's Eric with Option Edge, and today I want to go do a little deep dive into what is gamma and how that affects your options trading and everything. So let's get right to it. So here's the formal definition of gamma. So gamma is the rate of change in an option's delta per 1 point move in the underlying asset's price. So let's try and break that down in English. So we're talking about, when we talk about underlying assets, we're talking about stock price. So a 1 point, let's say a $1 increase in the stock price is going. So we're looking at a $1 increase in the stock price. We want to know, how will a $1 increase in the stock price affect the delta? How will the delta change when a $1 increase happens? Will the delta increase by 5? Will it increase by 3? So that's sort of what that is. So gamma is a measure of how much the delta will change with respect to a 1 point, it doesn't matter, 1 point or more points move in the stock price. So if it's always easier to talk about a 1 point move just for calculating stuff. So again, if the stock moves up by $1 and we have a 50 delta call, will the call be now 53 or 55 delta? So that's sort of so if it's a 53 after a dollar move, if it's a 53 delta call, that would mean the gamma was 3. Okay, and if it was a 55 delta call after a 1 point move, that would mean the gamma was 5. But we'll show some more examples of that. So gamma continued. Gamma is the first derivative of delta. It's also the second derivative with respect to price of the Black-Scholes model. Okay, you don't really need to know that. I mean, it doesn't make you doesn't really make you any better at options. It's just something interesting to know. And I'll show you how this sort of relates to, there's a good example about like physics. So just keep that in mind, that gamma is the second derivative of the Black-Scholes model with respect to price. And gamma is the first derivative of delta. So if you take the derivative of delta, you get gamma. Delta of delta measures change in delta. Yeah, so gamma is the delta of delta, so the change in delta. So then I'm going to go into in a little bit something an intuitive relationship. You can think of delta as velocity and gamma as acceleration. So let's go to the next slide. So if you've ever taken physics in high school, you learn that when a particle starts to move, that has, let's say, a speed of, or a velocity has direction. Let's say you're moving 30 meters per second, but you're at a constant speed. That would mean you have a velocity of 30 meters per second. But when you start to go from 30 meters per second to 40 meters per second, that means you're now accelerating, right? Because there's a change in that speed, and that's acceleration. So in a way, you can think of gamma is like the acceleration of your options price. Okay. So yeah, and this is just showing the derivatives over here. So basically, the most important thing you have to know about gamma, this is one of the most important things, is if you are long options, for example, let's say you're long a call, you have positive gamma. So when gamma increases, your call will increase in price. Okay. And then the opposite holds true when you are short, let's say a call, or short a put. Okay. When you're negative, you have your bearish gamma, your negative gamma. So if let's say you sell a call option, okay, and the stock price moves up, which is what we don't want. The stock price is moving against you. That's going to increase in gamma. So let's say you have a out of the money 20 delta call that you're selling. Okay, the stock price moves up 5% in a day. That call, let's just say hypothetically, has gone from a 20 delta to now a 45 delta. Okay, so that means that we're almost in the money. Okay, so as we approach, and I'll go over this, as we approach to at the money and in the money, that is when gamma is at its highest. Okay, so obviously when you're short a call, you want the stock to go down. You want it to stay away from your strike price. you want to be out of the money, and yeah. So okay, calculating gamma again. So delta, so gamma is the change in delta divided by the change in stock price. Okay, and that yields gamma. And here's another little example of calculating gamma. If you have a stock, let's say it's $200. Okay, and we have an at the money call with a strike of 200. Okay, so that means if we're at the money, that the delta is right at 50. Okay, we have a 50 delta option contract. Okay. And if the gamma is 3 of that particular options contract, and we experience a 1 point move, so in the stock, so now the stock went from $200 to $201, the options delta would change to 3. Okay. Now the same holds true in the reverse direction. If the price moves down $1, so the stock price goes from 200 to 199, we have a gamma of 3. The options delta would now be 47 because 50 minus 3 is 47. Okay, I hope that makes sense. And we'll do a couple more calcs here. So if the stock increases by $1, and this LC stands for long call, so with a delta of 35, and that particular long call has a gamma of 3, stock moves up by $1, we now have a new delta of 38. If the stock moved up by $2, we'd have a delta of 41, okay, because 2 times 3 is 41. So let's look at the short side, okay? We have a short call that's the delta is negative 75, okay? So that means we're short gamma, okay? If the stock moves up $1, which is what we don't want, we now have a higher delta call, okay? We want if you're short a call, you want your delta to approach 0 and be out of the money. But the minute you get over a delta of 50, you are now in the money. And if you're selling options, you do not want to be in the money because then now you're obligated to sell contracts for a loss, okay? Sell stock for a loss. All right, and then this is the same thing if I cut out the stock. So same situation, stock's going to increase by $1, but now this is the put side, okay? So if we're long a put, okay, we want the stock to go down, but if it increases by $1, our delta is going to change and be less, okay? So if we have a gamma of 2, stock moves up $1, now our delta is going to be 38. If the stock moved down by $1, our new delta would be 42, and which is what we'd want. Okay, so now we're short a put. Okay, and for short a put and the stock moves up $1, that's good for us. We want that to happen. But when you're short options, your delta decreases. Okay, which is good. Okay, which is good. But it also means that your original option is less potent, less directionally exposed. Okay. So another main takeaway about delta is if you buy a contract that has, let's say, a long enough date, for example, like 45 days, which is plenty of time. Which is like a decent amount of chunk of time to hold an option. The first half of that contract's life cycle, you're really not going to experience gamma risk. Okay, gamma doesn't really increase until the end of the life cycle of the option. Okay, so we're going to visualize that here. So okay, we have the September, October, December. Okay, so September is the shortest dated option, and you can see that gamma is the highest. Okay, we go out another month to October, you can see that gamma is far less high, and then same thing December, it's almost like a flat curve. So as time decreases, gamma tends to increase. But for the at the money options, if you look though, the out of the money and deep into the money options, the gamma really starts to drop off on those. And the reason why for that is with the longer dated options, there's still a chance that an in the money option could become out of the money, and the same thing holds true the other direction, that an out of the money option could potentially become in the money. Okay. Next slide. So here is at the money strikes and gamma, and you can sort of see strike prices are plotted here. You can see that at the money. So right here is the highest, and this is what this is showing you here. That gamma is the highest at when the strike of the option is at the money. Okay. So when is gamma highest? Again, at the money options are most sensitive to gamma. When the option is near or at the money, gamma is at its largest. Gamma is also larger the closer to expiration. So as time decreases and you're at the money, gamma really starts to ratchet up. Smaller the further away it is from expiration. Gamma, that's referring to gamma. So gamma is smaller the further away you are from expiration, and that's sort of illustrated here with, if we look at December, our gamma level is much lower than the options that are expiring in September. Okay. And so here's an interesting thought experiment. So OPEX options expiration. So how does gamma behave at options expiration? So if you think of this, an option at expiration, let's say you own a call. Okay, it has a 50 delta. Okay, and when an option expires, it either expires in the money or out of the money. Okay, so when an option is in the money and there's no more time value, your delta becomes 100. When it's out of the money and there's no more time value, your delta becomes 0. Okay, so let's say you have an hour left and before the option expires, and you're at the money, your gamma is going to be extremely high because your delta is constantly changing. It's changing very fast. It's going from 100 to 0, depending on how the stock fluctuates. If the stock goes up a little bit, you go to 100 delta because now you're in the money. If the stock goes down a few cents, you're now out of the money, and you have your delta 0. So that's a huge change in delta. So a large change means large gamma. Okay, so highest gamma is at the money at options expiration. Delta oscillates from 100 to 0 instantaneously. And we call this the gamma knife edge. You're right on the edge between 100 to 0, and that gamma is just huge. Okay, I hope that makes sense. It's a little bit more advanced. So when is the gamma the lowest? And we're going back to this here. The longer the date of the option, and when we're further out of the money or in the money, gamma is going to be lower. But actually, as time goes by, there's less of a chance of being in the money or out of the money, so that means gamma is going to be the lowest. So the less time, the less chance for the in the money or out of the money option to become in the money or out of the money. So here's another interesting thought experiment: is does stock have gamma? So one share of stock equals 1 delta, right? So that means 100 shares of stock is 100 delta. But for stock, if you own 100 shares, depending if it goes up or down, your delta doesn't increase or decrease. Since there's no increase or decrease, stock has a gamma of 0. Okay, the delta doesn't change, just the stock price. Okay, so that's just something to think about. So here's the main takeaways about gamma. Okay, so when the stock moves, when the underlying stock moves, the delta of your options change. This change in delta is gamma. Okay, your options will get more or less potent or strong or powerful depending on whether you're long or short, and if the stock is going with you or against you. So, for example, if we own a call at 50 delta and the stock rallies higher, let's say our call will then be worth will then have a delta of 60. Okay, so now we have more directional exposure to that underlying asset because now our delta is higher. Okay, so that's basically what this is saying. And the same thing works the other way. If we buy a 50 delta call and the stock price moves down, well, now our call is going to become more out of the money. So it would go from 50 to, let's say, 40. So we now have less directional exposure to that stock. Okay. And in addition, we also have a lower probability of being in the money at our options expiration. Okay. And then at the money strikes have the highest gamma. I think we sort of did a good job of talking about that and showing the graphs how that is. Longer the expiry, the less gamma option will have when we're talking about at the money strikes, not the out of the money and deep in the money strikes will have less gamma. Okay. And when expiry approaches, gamma risk increases. So that's sort of one of the main things. So like that's why you shouldn't, if you're a net seller of an option, it's better off to close early than wait till options expiration when you can have this huge gamma risk. And you can a stock that, let's say, if you're a net seller of options, a stock that's out of the money, which is good, can then become in the money, and you end up losing a lot of money. So just be cognizant that as time passes, gamma risk is increasing. Okay. And that's it, boys and girls. I hope that was a good little deep dive into gamma. And if you have any questions, please feel free to hit me up. And as always, please like and subscribe to this content if you're finding it useful. And this is only for educational purposes. It's not advice. All right. Peace out. Bye-bye.